follow a tech company presentation or a tech investor presentation, but I have to say the tales of Uber did remind me of an observation I heard a few years back, and say with our kids 20 years ago, we probably would have given them two rules when it comes to growing up, or teenage kids. Number one, never get in a car with a stranger. Number two would probably never ever meet anyone you meet on the internet. Nowadays, we use the internet to meet people and get in their cars. So things really have changed. If any of you are feeling a little bit queasy about some of the developments outlined in that presentation, don't worry, I'm with you a little bit, although I would agree with a lot of the observations in there. I'm going to talk on, this is going to be very different, almost an echo of Russ's presentation up at the start. And I'm going to talk about three things. Firstly, I'm going to take you into a debate where unlike in the tech sector, there's unequivocally good news, I think, for you as investors, and that's the debate around fees. And then going to broaden out and take that example of where different paradigms are emerging and give you a framework which, echoing Russ's observations, might be helpful for you as you embark on that challenge of finding funds or managers to invest in, which as I'll show, isn't easy. And along the way, hopefully I will introduce you into Orbis, give you a little bit about Orbis, certainly in my conclusion. Orbis isn't a household name. Despite that, we have been in London for 27 years, so we've been doing global investing for a long period of time. I'm excited as the head of UK to be bringing what we've been doing for institutions and high net worth investors into the mainstream UK market. So with that, I'm going to kick off. First thing, I really want just to sort of acknowledge, really, I've been part of the investment, I've got 15 years experience in the investment team, and it's worth just putting this up on the table. Picking funds or fund managers is harder than picking stocks. I think there are three reasons for that. Firstly, there are 76,000 global funds available out there, and that compares to probably about 5,500 listed equities. So you've got the numbers against you when you're looking at funds initially. The second thing is, despite all the comments about accounting standards, you do at least get reasonably consistent numbers in some sort of prescribed format and audited vast majority of the time. When it comes to funds, you don't always get that. The disclosure can be much more variable. But I think the killer blow, the third factor, which makes it very difficult to pick good funds, is unfortunately the statistic shown in the blue pie in the pie chart, which is that, and now the number varies, but under this survey, only 20% of the funds actually tend to deliver on their fees that they charge over time. And that third point is quite sobering, really, and it's no wonder when statistics like that are being bandied around that people are furious about what our industry does. So these are some of the headlines. Sunday Times, funds rip-off fees attacked. Financial Times, active managers need to prove their worth with performance pay. So what do you do as individuals looking for a place, a home for your hard-earned savings? Because it's a very important role that each of us has to confront at some point in our life. And one option, you could jump on what is now essentially a bandwagon. You could get on the bus and go and join the passive brigade. And in doing that, you get the average, and that can be fine. It's not a crazy outcome. The big argument that the passive industry would put forward is that fees, even if they sound small, compound over long periods of time. Let's have a look at that. This is the 40-year history, and this is what the S&P 500 price series looks like. Now imagine that was what you could have got. Instead, you had to pay 1% fees to invest in that over that time frame. That's 1% per annum. Sounds small, but it compounds over time. And you can't see this straight away on the chart because we've used a logarithmic scale again. But the key point is that even just paying 1% per annum, the end value after 40 years by paying that 1% fee is a third lower than without the fee. Small numbers compound. Now, of course, the passive industry stops there and doesn't go on and make the next step, which is what the active management industry says. It says, well, that's all very well, but the benefits of good, long-term, successful active investing also compound. So if you can do it successfully, you can actually harness what Einstein called one of the eighth wonder of the world, the miracle of compounding in your favor. And to show that, I'm very glad, Russ, you mentioned Berkshire Hathaway a lot, because it actually makes this slide much, much easier. To show that, I'm actually going to put the long-term performance of Berkshire Hathaway onto the chart. And at this point in time, if there's anyone from the passive industry up here, they'd be jumping up and screaming blue murder, saying you can't possibly compare the index against a cherry-picked, with hindsight, best-performing active fund. And of course, they'd be absolutely right. The point I'm trying to make is a bit more subtle here. I'm afraid I played a bit of a trick on you. And those aren't actually the returns of Berkshire Hathaway. They're not the returns of Orbis's fund either. They're Berkshire Hathaway's returns, but I've added a fee every year to the returns that they actually generated. And I set the fee level, I had to come up with a number, but I set a fee number which I think most people will go, there's no way on earth I'm going to pay that in management charges, back and either now or back in 1977. So I set that fee level per annum at 4%. And the key point I want to make to you is that when you hear all this noise about the level of fees, it's not actually the level of fees that matters. It's whether or not you're getting value for money. And that's what's exciting about the debate that's happening at the moment, because I think we're finally getting to speak common sense about what actually matters when it comes to active investing. If you're investing in a passive fund, it's a commodity product. Yes, you want to go for the lowest fees possible. It's a commodity product. When it comes to active, you need some linkage to value for money. So when it comes to value for money, the two things that matters, obviously, firstly, the fees, and secondly, the performance you get. So let's touch on each of those separately. When it comes to fees, there are probably two dimensions that people ultimately think about in fee structures, and get stuck in the detail here for a long period of time. But when you boil it all down, the two things that people tend to focus on. And firstly, it's this: are the fees linked to the value created? That's one nice dimension that people would tend to seek in fees. The second dimension is whether those fees are stable and predictable. Because whatever it is, as humans, we tend to like certainty and predictability. Now, the unfortunate challenge when it comes to investing in active funds is that the nature of our service is such that you are not able to assess, or nobody is able to assess, what the value that active fund manager is actually going to generate for you over the period that you're invested. And as a result, these two dimensions, stability and predictability, along with linking it to value, are fundamentally in conflict. You cannot have both. And that matters because the industry so far has focused on charging along the stability and predictability asset. The dominant fee model is charged as a percentage of assets under management. In many ways, that's great. I'm not saying it's wrong. It's simple to calculate and you know what it is. But it cannot provide you this linkage to value for money. The reason I started with this is that this whole debate around fees has been burst open again recently with an announcement by no less than Fidelity, who's come out in the last couple of months saying that they're going to introduce a range of funds that have the fulcrum fee model on them. Now, without getting into technicality, fulcrum basically provides an element of linkage to the performance generated by the funds and gives up on some stability. I'm not going into the details, but the key point is that they have implicitly recognized that we need to do something more in terms of generating value for money. And if Fidelity are going to do it, I would suggest that there are other people thinking about it. In fact, I know that there are plenty of other people thinking about it. Because as Orbis, we've always believed that getting value for or charging on a value for money basis is critical. And in the UK, we've taken our fee structure to what we believe to be the logical extreme of that, in that we have a fully symmetric fee mechanism, which means we essentially only get paid if we do a good job for you above and beyond what an index would be able to provide. In brief, the details are that we pay the ongoing charges of the vehicle. So if all we do is perform in line with the benchmark, then we'll actually be cheaper than the tracker fund. In exchange, the fund is charged a performance fee or variable fee, which equals 50% of the outperformance. But that's not paid to us straight away. That's held in a reserve. And if we subsequently underperform, the fees flow back to the fund by way of a refund mechanism. The net effect of all of that is that we can only get paid if we outperform and then sustain that outperformance. So really what I want to leave you, the thing I want to leave you with in this section is just to say there is a debate. Things are changing because I think a lot of people are considering this now. Fidelity's introduction is a big deal. And ultimately, I think it's good news for you as investors because it starts providing a linkage towards mechanisms that mean you're more likely to get value for money. But the flip side of value for money is obviously performance. And here I want to broaden out and echo some of what Russ said and perhaps give you something of a different framework when you think about looking through those hundreds or thousands of funds that you have available to you. And the challenge with picking funds is that the data or the information that's most readily available to you is not necessarily all that helpful. The 3-year performance numbers are very easy to generate. In fact, they're one of the first things that pop up. But unfortunately, there's no predictive power if you look at the 3-year performance rates or even 5-year as to what's going to happen in future. And the dilemma that fund selectors and investors have is neatly captured by this quote, which says, not everything that can be counted counts, and not everything that counts can be counted. So I thought I'd talk through a framework that we think about as we think both about our investments and how we've structured the organization, to perhaps give you some pointers in your quest for good funds. The first two factors that I'll mention are pretty obvious. Firstly, a time-tested investment philosophy. Keywords there are time-tested. We have, as you well know, been in a bull market for 8 years. It's only when the tide goes out that you discover who has been swimming naked. I would argue that anyone who hasn't been tested through an up and a down cycle has still not passed that test yet. Second element would be, do they have a robust process? That may sound, again, fairly obvious, but it also may sound something that's quite hard to assess from the outside, and I think it probably is pretty difficult to assess from the outside. But there is one element which I think is worth considering. If you have a fund or a firm that is dependent on a single key individual, I would put it to you that is inherently less robust than a fund that's based on a team-based approach. So those top two factors, and note that they are interlocked. We do that deliberately because I don't think you can have any one of these. They all interconnect with each other. Those top two factors talk about how the investment happens. The second half of the box that I'll talk about now really addresses the point of how the organization that is offering those funds to you is built, and whether or not that supports or conflicts with what the fund is trying to do. And we would argue that these are at least as important. The bottom two factors are necessary conditions. I would argue the top two are critical to understand as well. First point is alignment of interest. Second point is the ownership structure. And I'll go into these in a little bit more detail. What do I mean by an alignment of interest? Well, I've touched on it a lot in the fee debate. If you have fee structures that are driven by how well you do on behalf of your clients, immediately you're going to be much more aligned than fee structures which basically reward you for getting your firm bigger. So that's a critical part of it. A second one is co-investment with clients. I think it's a perfectly reasonable question to ask managers how much they have invested in their own funds. And not necessarily how much, but how much of their investable net worth. Let's go for it. Don't hold the punches. And the second factor to be aware of is, are they investing on the same terms as you, or do they invest in fee-free share classes? At Orbis, all of our staff and investors and everyone connected invest on exactly the same terms as our clients. We think that's critical because it forces the individuals to consider really what it is that they are doing. I've also touched on the performance fees structures already. Really, when we look at it, it means we know as a business we can only survive and thrive if we do a good job for our clients. In terms of ownership structure is one that really gets the least amount of press. And it matters in a subtle way. Most of the time, it probably doesn't actually matter. But when it matters a lot. And the reason is because if you're going to be a successful long-term investor, you have to invest very differently to the index. And if you invest differently to the index, you are going to go through periods when you underperform. It's inevitable. It's statistically inevitable. And when you do that, your business is going to come under pressure, financial and commercial pressure. If you do not have an ownership structure as an asset manager that supports that and understands the pressures that you will go through, then it's highly likely that those owners of the business, they might be public shareholders or they might be the CEO of a bank who doesn't really understand what the asset management does other than cause him compliance nightmares. It's highly likely those people are going to pull the plug on you right in the middle at the trough of a period of underperformance. And the reason that matters is that's typically the best time to be invested in the funds. Because performance is quite often cyclical. Right, I need to move along. That's the framework I've set out. A couple of bits to introduce Orbis to you. Here are some facts. We're founded in 1989, but our origins really go back to 1973, when our founder, Alan Gray, set up his first firm, which is now Africa's largest privately owned investment management firm. So between us, we have over 70 years of investing with the same investment philosophy. We are sister companies. We are, as Orbis, we are active global investors, so we operate around the world. We have 10 offices and 4 investment offices. The London office is our biggest. We have 165 people based here in London. It's about 40% of our global staff. By active global investors, by the way, I don't mean we trade a lot. What I mean by that is that our funds end up very different from their portfolio benchmarks. The benchmark is the tool that you have to hold us to account. It's not the starting point for us when we come to put our portfolios together. All of our portfolios come together as a result of bottom-up stock picking process. Our investment team comprises 44 company analysts, which is way too many given the size of our firm. The reason we have so many is that one of the things we believe we do on behalf of our clients is invest proactively to develop the next generation of investment talent, so that when existing people in the firm come to retire or move on, then there are people waiting in the wings to take over and step up to the plate. Our investment philosophy echoes a lot of what Russ said, actually. We would trace our intellectual origins very much back to the Graham and Dodd, as interpreted by various people along the way. A key element, I won't go through these in detail, but the key element is being contrarian and being willing to be different to the market. While a lot of what we do as a firm is designed to protect our ability to retain contrarian positions. It's why some of how we structure the firm may often be seem different to you. Another way, just to summarize the investment philosophy in a very succinct way, is to say that our investment philosophy is designed to capitulate on when humans make mistakes in the market. And humans make mistakes when they're too short-termist and when they let emotions take over. And really, that's how we operate. In the UK, we have two strategies available. We believe in keeping it simple for our clients and not bamboozling them with hundreds of funds. I won't share with you my cynical reasons to why people do that, but we have two strategies. Both are available in OEICs and both obviously available on the AJ Bell platform. On the left, the global equity strategy is the flagship fund that was launched on 1st of January 1990, so it has a 27-year track record. The OEIC vehicle available in the UK is a mirror fund of that. That is a global equity best ideas, effectively 70 stocks from a combination of 5 portfolio managers. On the right-hand side, the global balance strategy is more recent. It's coming up for its 5th anniversary. It shares the same company analysis engine, but it has a fixed income component as well. Those are the returns of the global equity strategy, net of all fees. Apparently, I have to put that table in the bottom, despite all my comments earlier about three-year performance numbers. We've seen a number of cycles at Orbis, and our investment philosophy is one that has been proven to be successful through that. I don't think that human nature has changed fundamentally, despite Ben's and the technology sector's best efforts to make us more rational or programming. I think ultimately people will remain too short-termist and driven by emotions, and that's what we're designed to do. I think the critical point to note is that while that track record, it looks wonderful if you had just invested in 1990 and been able to sit through the last 27 years. Underneath that, or within that long-term track record, it's critical to note that there have been meaningful periods of underperformance relative to the benchmark. And we are highly active investors, and those periods of underperformance will occur again. Let that sink in. They will occur again. We can't stop it, but we see, as investors in the fund, we see that as the price that's necessary to pay for superior long-term performance. We'd love to be able to generate smooth short-term performance. It's just not possible, and so we just don't try. Our competitive edge is thinking about the long term. Global balance strategy, shorter time frame here. Key point to note is that we think the relevant comparator is the benchmark, not the peer group. But we put the peer group on because if I don't, somebody always asks. Rather than putting up the top 10 of the fund, which ends up being just a list of slightly idiosyncratic stocks, many of which aren't necessarily household names, what we show in this chart is the clusters of valuations that we see coming up through the portfolio as a result of our bottom-up process. And so these clusters between them make up nearly 50% of the global fund, and they make up about 9% of the world index. So it's really where we're very overweight. And I won't go through it in detail, other than just to highlight a couple of the big themes. And firstly, we're finding it much easier to find good value in emerging markets. And that's not a blanket call on emerging markets. There are some very scary emerging markets. There are some very scary sectors out there in emerging markets. But up until really quite recently, sentiment on emerging markets was so negative that in our view, investors had thrown out a number of babies with the bathwater, and there's some really attractive companies that we could own for far less than you would have to pay for comparable businesses in developed markets. So that'd be one. Our largest position today is a company called XPO Logistics. You may see them vans driving around London. That's in the group of what we call selected industrials. They're businesses which aren't very fashionable at the moment because they might not necessarily pay a dividend. They might be a bit more volatile than average. But we know the companies extremely well, and we're very excited by the turnaround and improvement stories at those companies. The third big exposure perhaps to draw your attention to is not on there. It's the dog that doesn't bark on this slide. It's kind of what we don't own. And we are extremely underweight the bond proxy companies, the consumer staples. And we believe that many investors there are confusing stability of those companies with safety. And frankly, as all of you will know, that no investment is safe if you pay too much for it in the first place. And we think a number of those companies are overvalued. Similar picture for global balance. We show the clusters. Similar themes coming through, but perhaps just touch a little bit on the fixed income space. The index is the 60-40 index, so 40% global government bonds. We are very underweight government bonds. We think they offer extremely limited value today. Interest rates are too low, and more specifically, we think the term premium, to get technical, the term premium is ridiculously low and nonsensical in places. In place of that, we actually are overweight equities. We have some limited hedging in place, but we also own some corporate bonds where our company analysis skill has enabled us to identify some significant mispricings. So with that, I just want to wrap up. A brief recap of what I talked through. Firstly, the fee debate, I think, is a great one. I think the times are changing, and I think they're swinging in the favor of investors, so it's good news. Secondly, I hope the framework I laid out might be helpful for you as you think about companies in future. In particular, it's the qualitative factors that are often harder to get, but can be certainly extremely important in thinking about whether a fund manager has an above-average probability of being successful. And the firm's architecture is a key component of that. And finally, Orbis, we are new in the market, but we're not new to the UK, and we certainly aren't new to global investing. We've been doing this for 27 years. Very proud and excited to be bringing our services to the UK market. And if any of you would like to speak afterwards, I'll be around, and I've got a couple of colleagues here as well, so feel free to come and grab us. Thanks very much.